Look, Paul, the economy is overheating. You look at our labor market. We've got almost 1 million vacancies in the labor market. The economy is in excess demand. We need higher interest rates to take out the excess in excess demand, bring demand back into supply to get inflation down. Part of that adjustment will no doubt come through the housing market. That's part of getting inflation back to target. Getting inflation back to target, getting inflation back to target, get inflation back to target, to get inflation back to target, get inflation back to target.
Well, you don't need to be a rocket scientist to figure out what his plan is. Or do you? I feel like there's so much more to break down from when Tiff spoke a couple weeks ago. He talks about housing. He talks about the economy being overheated. He talks about where the potential interest rate could go in the future. But when we look back to history, it doesn't line up. So in this video, we'll be covering through a few of the things that Tiff said, deciphering the message to kind of pull what is really going on in the background. But if this is your first time here, my name's Nick. Welcome to Ways to Wealth. Before we get into the video, huge favor, huge ask. If you learn something new or you get some value out of the video, hit that like button for me. I definitely appreciate that. And if you haven't already, please consider hitting that subscribe button and turning that notification bell on for similar content just like this. A few weeks back, Tiff Macklem came out and spoke a little bit about the Canadian financial system and a little bit about the motivation as to why they are raising rates and obviously why they are stopping quantitative easing. They're going into a quantitative tightening and not spending so much money. So what we hear in the first point, and we'll let a clip run right now, is about the housing market.
Look, Paul, the economy is overheating. You look at our labor market. We've got almost 1 million vacancies in the labor market. The economy is in excess demand. We need higher interest rates to take out the excess in excess demand, bring demand back into supply to get inflation down. Part of that adjustment will no doubt come through the housing market. That's part of getting inflation back to target.
Tiff Macklem and the Bank of Canada definitely do not care about the housing market at this point. Inflation is running extremely rampant, but it is important to note that they're pulling out old data points. We're looking at, what the unemployment rate is. We're looking at how healthy the consumer is in this country with household savings during the pandemic hitting all-time highs. We've actually seen a little bit of reversion to the mean, meaning that people's savings aren't as high as they once were. So we're almost looking a little bit in the past. But when we look about housing, even specifically, it's so crazy to see how quickly the market has turned already in just a short couple of months. And if he expects the interest rate to continue to go higher, how much more damage can we continue to see? So we'll be moving on to another clip and breaking it down right now.
With inflation well above our target, with the expectation that it's going to rise further before starting to ease, the risk that higher inflation expectations become embedded has increased. So what do you do about this? I think the important things that we're doing is we're being very clear about our objective. We are very clear. Our number one priority is to get inflation back to target. And we've been very clear with Canadians that they should expect a rising path for interest rates to moderate demand and bring it in line with supply. And I think, what we know is that the more Canadians understand about monetary policy, the more they understand how it works, the more confidence they have in how it's working. So we have been, I think, unusually clear with Canadians that they should expect a rising path for interest rates to bring inflation back to target, and that's our primary focus.
I must have heard that phrase, getting inflation back to target, 25 times when he was going through the presentation. Now, I know in this past comment, he makes reference to teaching Canadians about what they're doing in the background. But if there's anything that I've learned, I don't know if there's a true grasp as to what is actually happening right now. there is fears right now that they could be tightening too quick and they could be creating a recession. There's already some data points that are out there that is showing that the Canadian consumer is slowing down. There is points out there that is being made that the economy is already naturally slowing down. Well, they're trying to tighten the economy on their side. And with the economy already slowing down, they could be putting us in a situation that is even worse for us. So that is definitely a concern right now, is that are they over constricting? Are they creating a recession right now where we could be naturally just heading into one regardless? But we're going to roll another clip, and it's going to give us an indication to finish off this point as to where we could potentially be going if we look back in history.
We have indicated that with inflation well above our target, with the economy overheating, we want to get our policy interest rate back into the neutral range quickly. And we've indicated we think that range is between 2 and 3%. We think the economy can handle higher interest rates. We think the economy needs higher interest rates. At our last decision, we indicated that we were prepared to move more forcefully if needed. And last week, Deputy Governor Paul Beaudry also indicated that given that inflation looks like it's going to go higher before it eases, given that inflation has been broadening and the economy is overheating, the likelihood that we may need to go to the top of that 2 to 3% neutral range, or possibly somewhat above it, to bring inflation back to target has increased. So when we indicate that we're prepared to move more forcefully if needed, what we're indicating is we may need to take more steps, more interest rate steps to get inflation back to target, or we may need to move more quickly, may need to take a larger step.
Now, where I think Tiff is being a little bit sheepish here is that he's not giving a true indication of just how high interest rates could go. Now, I know he talks about teaching the Canadians about monetary policy, but when we take a look back through history, the last time inflation was north of 5% was during the 70s and the 80s, and I was able to find this chart, which we will show here, and just to show how high the interest rates had to go to curb inflation. So the dotted line there is the interest rate. And we can see here the inflation rate is the solid line. And during the 60s and 70s, there was a little bit of a problem with oil, which we're almost seeing in its same facet today about the supply of oil. And we see that in the 70s through the 80s, inflation climbed from 5 to about 10%. And in turn, the interest rate had to go from over 5%, which is way higher than where we're at today, all the way north of 15%. So when you hear about people that had mortgages back then, they're talking about 18, 20%. Now, am I saying that we'll get that high? No. But what I think we should be cautioning is that if we continue to see inflation rate run at about 6 to 7 to 8%, then we will need to continue to raise the interest rate higher than that. And when we look even to our neighbors in the South, anytime that inflation has been over 5%, they've had to make the Fed funds rate over 5 at equivalent to inflation or higher in order to curb it and bring it down. And if that is what the goal of the Federal Reserve or the Bank of Canada is to get inflation down, then I believe we are truly going higher than that 3 or 3.5 neutral range that the Bank of Canada and TIFF has stated. So, if we are to take a look past through history, going back to this chart here, again, the only way that we were able to curb inflation in the past is to get our interest rate higher than the percentage of inflation. So I think we are going higher. We've seen it hit the housing market already. I think there is more pain to come there. And I think we're really looking for more economic data to just truly determine where we're at in the state and, how much the Bank of Canada can push before they push us into a recession, which almost seems inevitable at this moment. But let me know down below what your thoughts are. What do you think the Bank of Canada is going to do? Can you see us north of 5% in the next 12 to 18 months in the economy and the interest rate? Or will we kind of stable out? Will the economy work its own magic? But yeah, if you're still here with me, hit that like button. I definitely appreciate your support. Don't forget to hit that subscribe button. I hope you all have a great week in the markets. Happy trading.